Today we're really focusing in on a single stock, one that's it's generated so much volatility and a ton of division on Wall Street.
You go about super microcomputer.
SMCI.
Exactly. Ticker SMCI. And we have this really intense analysis report on our desk. And the mission here is pretty precise. We need to cut through all the noise, all the recent stock performance, to uncover what this report calls the secret weapon.
The secret weapon that it says will shock the market when Q2 earnings drop.
Which is coming up in February.
It's a fascinating setup. It really is. Mostly because of, the pain the stock has been through.
Yeah, right.
I mean, if you followed SMCI at all, you know it went completely parabolic, hit highs over $66, and then just a sharp retreat. It's been trading down in the $30 range. The consensus has sort of been that this is, dead money.
Dead money is the perfect phrase. It just felt completely directionless. But then we saw this small, but I thought very deliberate flicker of life last Friday, January 2nd.
Nearly 6% pop. Yeah, closing near $31. It's a tiny move in the grand scheme of things, but it feels like it's signaling that something's shifting under the surface, don't you think?
It absolutely does. The market is conflicted. You can feel it. They see the history, that aggressive selling pressure, but then you look at the fundamentals and they're screaming something completely different.
Okay, let's unpack this, because the main thesis of the analysis, the real core of it, is that Wall Street is just looking in the wrong direction.
Completely.
They're fixated on the rearview mirror, all the issues from Q1, and in doing that, they're completely ignoring the massive potential
Well, it's staring them in the face right on the windshield.
That's the critical disconnect we have to explore. That rearview mirror, that's the whole bear case. It's all focused on these temporary setbacks. But what the bears are, I think, willfully ignoring is just the unprecedented Q2 revenue guidance the company put out. Management is laying out a future that is completely, totally inconsistent with the stock's current price. Okay, let's get into the sheer magnitude of that guidance. I mean, this is really where the shock is going to come from. For you listening, these are the numbers that show why this analysis is so bullish.
So if we look at the base, right, Q1 revenue came in around $5.2 billion. The report calls this, respectable, steady, but flat, sequentially flat. It didn't really inspire a lot of confidence.
Right, stability, but no ignition, no spark. But then you look at the guidance management gave for Q2, they guided for revenue to land between a massive $10 billion
and $11 billion.
And $11 billion.
That's the jaw dropper. And what's so fascinating is when you translate what that forecast actually means, management is projecting to sequentially double their revenue.
Double it.
We're talking 100% quarter-over-quarter growth in just 3 months.
A 100% sequential jump. For a company this size, it sounds less like real guidance and more like some aggressive marketing hyperbole. Does the report mention any historical precedent for that kind of audacious number from a hardware supplier?
Typically, no, not at this scale. Most established tech companies, especially in hardware, they fight tooth and nail for, 10 to 20% growth over an entire year.
A whole year, yep.
So a 100% jump in a single quarter is usually something you see from a tiny startup or, a company with a massive merger.
Yeah.
SMCI is basically telling the market, we're about to execute 2 years of growth in the next 3 months.
And if SMCI hits anywhere near that $10 or $11 billion number, which is around February 10th when they report, the analysis is crystal clear on this point. The current $30 stock price is, and I'm quoting here, mathematically broken.
It has to be. If that guidance is real, if they hit it, the market will be forced to completely re-rate the entire company. You can't have a company doing 100% sequential growth and still price it like some slow-moving commodity hardware vendor. It just doesn't work.
It would have to be reclassified overnight.
As a hyper-growth AI infrastructure giant. Exactly.
Okay, but even if that revenue forecast is true, the skeptics always have a comeback, right?
Oh, always.
It comes back to valuation, how expensive the stock is, or maybe more importantly, how little they seem to be making right now. Let's pivot to that bear case, the valuation gap and the margin worry.
The current valuation is really the key point of conflict here. So the report lays out the multiples. The PE ratio is trading around, let's say, 24.99.
Okay.
And for a standard, non-AI slow growth hardware company, you could argue that's a fair price. But that's the whole point. The market is misclassifying them.
And the price to sales ratio makes that point even clearer, doesn't it?
Precisely. SMCI is trading at roughly 0.8 times sales. 0.8. Now, contrast that with the pure play AI software stocks, or even at a company like NVIDIA when it hit these kinds of inflection points.
They're trading at what, 10, 15 times sales?
Or even 20 times sales. This massive gap, it suggests the market has completely failed to price in the company's role, just how critical it is to the whole AI build-out.
So if SMCI were to trade just like an established key AI leader, We'd be looking at a PE, what, closer to 60 or 70, not 25.
That's right. And that's the opportunity. The gap is between how it's valued today, like a commodity server builder, and how it should be valued tomorrow as essential AI plumbing.
But we have to address the biggest point the bears hang their hat on, the margins.
Yes.
The gross margin recently dipped to a pretty concerning 9.3%. That is a very low number for any tech company, growth story or not.
And if we connect this to the bigger picture, the analysis gives some crucial context. It really refutes the margin worry as a long-term problem. You have to think of that margin hit not as a loss, not as a sign of weakness, but as a one-time cost, like laying down a new railway line.
An infrastructure investment, not a business failure.
Exactly.
Yeah.
The report explains that dip was because the aggressive and necessary cost of ramping up brand new, very complex liquid cooling production lines. They were spending the money up front in Q1 to build out this massive capacity, and that cost temporarily hits the profit calculation.
So the margin dip was actually a sign of them preparing aggressively for this huge future demand.
Correct. And the analysis suggests this expense is temporary, as those new lines reach full capacity in Q2 and Q3.
The very quarters we're expecting this massive $11 billion revenue ramp.
Yes. Margins typically normalize, and when they stabilize against a revenue base that is doubling sequentially, profits tend to. Well, they explode. The pain was an investment, and the return is about to hit the P&L.
Okay. Here's where it gets really interesting for me. Let's move beyond just the financials and identify the technological driver here. The thing that makes a 100% growth forecast even sound believable.
Right.
Because the common dismissal is that SMCI is just a box mover.
That bear narrative is so outdated, it's dangerous for anyone who actually believes it. The reality, as this report defines it, is that SMCI is the liquid cooling king.
The liquid cooling king.
That's the true secret weapon, the technological differentiator. It's the critical piece that gives management the confidence to guide for that kind of impossible growth.
So for anyone who might not know, explain the physics here. Why is liquid cooling suddenly mandatory for these high-end AI data centers?
It's all about thermal limits. It's pure physics. The newest chips from NVIDIA, from AMD, the ones you need for training these cutting-edge language models, they generate a staggering amount of heat.
More than ever before.
Way more. We are past the point where traditional air cooling can handle it. If you try to run these new chips in a standard air-cooled rack, they'll just overheat and throttle down. You waste immense computing power.
So if you want a modern AI data center running at peak efficiency, liquid cooling isn't some premium add-on anymore.
It's non-negotiable. It's a requirement.
Mandatory.
It is mandatory. And SMCI's dominance is specifically in rack-scale liquid cooling. This isn't just selling some specialized coolers. This is building and integrating the entire plumbing and infrastructure you need to manage thousands of these chips in one data hall. That level of complex integration, it creates a huge competitive moat. It's very hard to copy.
Which means those supply chain issues that caused the temporary margin dip, yes, they were temporary. But the underlying demand for this specialized, bottleneck-breaking cooling technology is, as the analysis states, basically infinite.
It has to be.
Oh,
It's the key enabling technology for the entire AI industry to keep expanding. The whole narrative has to flip. You're not buying an average server company. You're buying the plumbing and the thermal management that the AI revolution needs to physically function. They're selling the solution to the single biggest physical constraint in modern computing.
okay, let's switch gears quickly and look at the technical analysis in the report. Because no matter how strong the fundamentals are, the price action has to confirm the shift.
Absolutely. And the technical picture is setting up, perfectly to confirm that fundamental story. The stock has repeatedly tested that $29 to $30 level since the big sell-off. And crucially, it has refused to break lower. This persistent defense of that level, that's the line in the sand the analysis talks about. It's a very clear double bottom pattern, which signals strong institutional support right in that region.
And that move on Friday to $31.14 after hours, that was the trigger for the technical traders, wasn't it?
It signals a definitive breakout from the falling wedge pattern that defined the whole downtrend. So when a stock holds critical support and breaks out of a resistance pattern like that, it tells traders the trend has probably changed from bearish to potentially bullish.
The report also points out one of the most compelling structural details, this air pocket. Can you clarify that for our listener?
Yeah, this is a really significant detail in technical analysis. There's a massive air pocket, or a gap, between the $35 and $50 levels.
What does that mean?
It means the stock fell through that area so fast during the panic selling that no real support or resistance was ever built. There were no buyers or sellers digging in to establish a foundation there.
And what does that mean for the stock moving forward then?
It means there's very little overhead resistance. So if the fundamental catalyst, that stunning Q2 revenue news, drives the stock to clear the $35 hurdle, the analysis suggests it could fill that gap very, very rapidly. Once it's past 35, the path toward $50 is, technically speaking, clear.
So if the technical breakout lines up with the fundamental news of $11 billion in revenue, you get a classic explosive combination.
It creates a powerful feedback loop. The fundamentals drive the price past the technical triggers, which then brings in the momentum traders who chase those signals, which just accelerates the whole move higher.
This has been a really compelling deep dive. To summarize the core argument here for you listening, this analysis is suggesting you are potentially looking at a company that's guiding for a phenomenal $11 billion in revenue, while still trading at a modest $18 billion market cap, a valuation that reflects the past, not this impending future. So what does this all mean? It means this analysis frames SMCI as a classic buy the fear setup. The market is paralyzed by these temporary, one-time margin problems, the cost of building out new capacity. And that fear is completely obscuring the massive technologically driven future growth from their dominance in liquid cooling. Your focus has to be on that absurd growth forecast.
And this raises a really important question for you, the learner, to consider as you digest all this. Given the report focuses so heavily on this mandatory expansion of essential infrastructure liquid cooling and that $11 billion revenue number, what adjacent companies or suppliers must also be seeing a similar exponential ramp in demand that the wider market just hasn't priced in yet? Think about it. Where is that $11 billion of revenue sourcing its high-density components and cooling materials from? That's the next layer of opportunity this analysis unlocks.